In the realm of dollars and dreams so sweet, there's a place to plant where ambitions meet. Comfortable profits, a name so grand. Invest your seed, let's watch it span.
Investor psychology. A plethora of information exists about markets and securities, how the market is doing, which stocks are in trouble, trade wars. But in comparison, we don't pay that much attention to dysfunctional psychology in decision making that leads investors in the wrong direction. In this video, we look at psychological traps that investors should look out for. Overconfidence. Let me ask you a few questions. Are you a good driver? Compared to other drivers on the road, are you above average, average, or below average? If overconfidence is not a stimulus behind your answer, 1/3 of you would say above average, and 1/3 would go with average, and 1/3 would choose below average. But overconfidence is usually a stimulus. In a study, when these questions were asked to participants, 82% rated themselves as above average drivers. Obviously, many of them were mistaken. This is the definition of overconfidence, exaggerating one's ability to perform a certain task. Research shows that overconfident traders trade more frequently than their less confident counterparts. The overconfident lot believes that they are more capable than others of stock picking and know the best times to enter and exit a position. However, Terence O'Dean, a professor of finance at the Columbia University, proves in his research that overconfident traders generate lower yields than the market. Number 2, anchoring. Anchoring refers to using irrelevant information to evaluate or to find something unknown. In the context of investing, it means being a slave to your preconceived opinions about an investment and strengthening your opinion by relating it to irrelevant factors. For instance, if you like a company, you might think it's a buy simply because you like it. So you pick and choose information and news about the company that confirm your bias. The number or the financial reports might be telling a different story, but you're anchored by your opinions. Emotional attachments to securities can damage your financial health. Sunk cost. A sunk cost is simply a cost that has been incurred, money spent. So sometimes what happens is that an expense doesn't sit well with an investor, so he keeps trying to recover this cost. In a way, he tries to protect his previous decisions, which can prove disastrous for future investments. This happens to those people who have a really hard time accepting that they've made a bad decision. Accepting a loss becomes excruciating. A related behavior regarding attachment to sunk cost is to seek out opinions that validate your bad decisions. Say, you bought stocks of a really bad company. Objective analysis shows evidence about its failing financial health, but you keep a circle of friends that advise you to stick to the stock. The ostrich effect. It's similar to what it sounds like. You bury your head in the sand instead of facing danger. It's also called the blindness trap, where you shut out market realities instead of confronting the losses. What an investor is really doing here is postponing to address the situation. It's an excuse to remain inactive. Say, you bought the stocks of a company some time ago, but now the company is facing a big scandal. If you avoid reading about the scandal on purpose, you might be the ostrich. Number 5, fallacy of relativity. Your life experiences and your financial situation are unique. What applies to someone else doesn't mean it applies to you too. It's a good thing to be aware of what other investors are doing, but you need to be watchful. If you see a friend making a small fortune by investing in high-risk investments, it doesn't mean that you should too. He might have a bigger risk appetite and can afford a big loss. You, on the other hand, might not be that risk tolerant. Invest in those securities that you can manage psychologically and financially. Number 6, stuck in the past. Sometimes an investor relies too much on the past, to the point where he speculates and tries to predict market movements, acting as if there's no uncertainty in the market. The only thing certain is uncertainty. Crashes, panic selling, bubbles, misconduct, all of these events create uncertainty. If you start believing that you can predict the future because you have studied the past, that's overconfidence or delusional behavior. When enough investors are overconfident, it's known as irrational exuberance. When such like-minded investors flock the market, a correction becomes inevitable. If the market has been riding the bull for the past decade, it doesn't mean that it will stay like that forever. Number 7, pseudo-certainty. The victims of this trap would limit risk exposure when they assume that the portfolio returns will be positive, protecting their lead. However, they gradually increase their risk exposure when it seems they're headed for a loss. In other words, investors limit their risk when their portfolio is performing well and seek additional risk when the portfolio is struggling. This happens mainly due to the urge to retrieve money. When an investor loses money, he somehow thinks that he's entitled to recover the loss, and in this pursuit, he keeps piling up losses. There's a reason why average investors lose money in the market. Most of them are inexperienced. On top of that, they frequently get ensnared in these psychological traps. Professionals, on the other hand, manage all types of portfolios, from risk-seeking to risk-averse, from individuals to billion-dollar funds.